Okay, next thing on the list is let's talk about cross-collateralizing. And it's obviously a mouthful to even talk about that word. I still get a lot of people that come up to me that still don't really understand the differences. Do you want to explain kind of roughly what it means? And we've actually got a few examples that we'll put on the screen after that as well.
Yeah, sure. So cross-collateralization is where you have two or more properties and you have one loan over those two or more properties. Okay, so we have got some examples on the screen for everyone to look at, so it's a little bit more explanatory.
So basically what it is it's where you've got say someone's got a home for, say, $1 million, for instance.
Yep.
And then they want to buy two investment properties. Typically, if you go to a bank, normally the bank will take all three of those properties together. So say if you've got $1 million home, you've got two $500,000 properties, they'll actually tie all three of those into one loan, won't they? And that's what the thing is, cross-collateralizing. It's all of those things. That's right.
They'll have one loan secured by those three properties.
Yep, and so effectively, actually we'll just jump to another one with some pictures of some houses that will hopefully show the viewers what we're talking about. So certainly where they've got the $1 million home, those two things, effectively what the bank says to them is that they can actually get more than 100% finance, can't they? They can actually get 105% on there. Yeah, so we've got it on the screen there.
Yeah, that's right. So in this instance, the borrower is actually borrowing 105% of the value of the property, including costs, and they're securing it by their owner-occupied or principal residence. So in this case, we have one principal residence for $1 million and two investment properties for $500,000 and a total loan of $1,050,000.
Yep. Now, if we then jump to the second slide, and then we'll actually look at that being three separate loans. What's the main advantage of having, say, two or three separate loans rather than having them all tied up together?
Yeah, sure. So thanks for that question. It's really important that consumers understand how their properties look when they're uncross-collateralized. And here's an example on the screen. We have three properties with three independent standalone loans. This allows the borrower to move around, to refinance, to restructure their loans without having to necessarily get permission from the lender before doing so. It also doesn't tie them down to not being able to sell their property if they want to sell their property in the future. It gives them a lot more flexibility, and this is a structure that I recommend ongoing to my customers.
Yeah, because the main issue is for these things is, and certainly when it comes to evaluation, is as soon as you want to buy another loan, the bank will then ask to revalue every single other property, won't they?
That's right, and in doing that there's going to be higher costs for valuations and stamp duty for the client. So in the long run, it can actually cost you more to have cross-collateralized property.
Yeah. And I guess the main thing for most people, I mean, I guess the only disadvantage about having three separate loans and borrowing the deposit from your main house and getting 80% on the other ones, there's maybe slightly more accounting, there's maybe you've got to be slightly more organised with your paperwork, but it is a lot safer and a lot more flexible by having three separate loans.
Yes, that's right. I mean, the banks will always make it look attractive by having, you know, one loan secured by three properties. They might offer you a lower interest rate because it's a lower lending ratio for them, and so of course that's more attractive to them. But in the long run, I really believe that that's tying you down to one lender and not giving you options. By having your property standalone, I think it gives you a lot more options and flexibility in the future to make, you know, informed decisions.